Hello everyone and welcome to this presentation on the statement of changes in equity. In this video, we will learn about one of the important financial statements used in financial accounting. While most people are familiar with the income statement and the balance sheet, the statement of changes in equity, often called SOCE, is equally important. This statement explains how the owner's equity of a company changes during an accounting period. In simple terms, it shows how profits increase equity, how dividends reduce equity, and how new investments from shareholders affect equity. By the end of this video, you will understand what the statement of changes in equity is, why it is important, what components it includes, and how to interpret it using practical examples. Before we start, let's look at what we will learn in this presentation. First, we will understand what the statement of changes in equity actually means in financial accounting. Second, we will identify the different components that make up equity, such as share capital and retained earnings. Third, we will learn how equity changes over time, especially due to profits, losses, and dividends. Finally, we will look at simple examples that show how accountants prepare the statement in real financial reports. The goal of this presentation is to make the concept easy to understand even if you are new to accounting. What is the statement of changes in equity? Now let's understand what the statement of changes in equity actually is. The statement of changes in equity is a financial report that explains how the equity of a company changes during a specific accounting period, usually 1 year. Equity represents the owner's claim on the assets of the business. In other words, it shows what belongs to the shareholders after all liabilities are paid. The statement starts with the opening equity balance, then shows all the activities that increase or decrease equity during the period. These activities may include profit earned by the company, dividends paid to shareholders, new shares issued, and other comprehensive income. Finally, the statement ends with the closing equity balance, which appears in the balance sheet. To understand the statement of changes in equity, we must first understand the components of equity. The first component is shares capital. This is the amount of money invested by shareholders when they purchase shares of the company. The second component is retained earnings. Retained earnings represent the accumulated profits that the company keeps instead of distributing as dividends. The third component is other comprehensive income, often called OCI. This includes gains or losses that are not included in the income statement, such as revaluation gains or foreign currency adjustments. Another component is reserves, which are amounts set aside for specific purposes. Finally, companies may have treasury shares, which are shares the company buys back from shareholders. All these components together form the total equity of the company. Now the question is, why is a statement of changes in equity important? First, it shows how the company's profits affect shareholder wealth. When a company earns profit, equity usually increases. Second, it shows dividends paid to shareholders. Dividends are payments made to shareholders from the company's profits. Third, the statement shows if the company issued new shares to raise more capital. This is important for investors because it shows whether the company is raising funds from owners or generating profits internally. Finally, the statement provides transparency. Investors, analysts, and stakeholders use this information to understand how the company manages its capital. Now let's look at the typical structure of the statement of changes in equity. The statement usually starts with the opening balance of equity. This is the equity amount at the beginning of the accounting period. Next, we add net profit for the year. When a company makes profit, it increases retained earnings and therefore increases equity. After that, we include other comprehensive income, which may also increase or decrease equity. Then we add any new share capital issued during the year. If the company issues new shares, equity increases because shareholders invest more money. Finally, we subtract dividends paid to shareholders. Dividends reduce retained earnings and therefore reduce equity. After all adjustments, we reach the closing equity balance. Let's look at a simple example. Suppose a company starts the year with retained earnings of $50,000. During the year, the company earns a net profit of $20,000. Profit increases retained earnings because the company keeps the earnings. Now imagine the company decides to pay dividends of $5,000 to its shareholders. Dividends reduce retained earnings because money is distributed to shareholders. So the calculation would be opening retained earnings, add profit and subtract dividends. This gives us closing retained earnings of $65,000. This change would appear in the statement of changes in equity. Now let's look at how the same example appears in statement format. We start with opening equity of $50,000, then we add the net profit of $20,000. This increases equity because our business earned income. Next, we subtract dividends of $5,000 since dividends are payments made to shareholders. After making these adjustments, we arrive at closing equity of $65,000. This format helps users clearly see how the equity changed during the year. Now let's consider a slightly more realistic example that includes share capital. Suppose a company starts with a share capital of $100,000, retained earnings of $40,000. This means the opening total equity is $140,000. During the year, the company earns net profit of $25,000. The company also issues new shares worth $30,000. This means new investors contributed more money to the company. However, the company also pays dividends of $10,000 to shareholders. When we combine all these changes, the company ends the year with closing equity of $185,000. Let's present this example in a clear statement format. Opening total equity, add net profit, then add share issue, and then subtract dividends. This results in closing equity of $185,000. This statement shows clearly that equity increased because of profit and new share capital, even though dividends reduced it slightly. This is exactly how accountants explain changes in equity to investors. The statement of changes in equity is closely connected to the other financial statements. For example, the net profit shown in this statement comes directly from the income statement. Dividends paid to shareholders are also reflected in the cash flow statement since they involve cash payments. Finally, the closing equity balance appears in the balance sheet under shareholders' equity. So, in financial reporting, all the financial statements are connected and support each other. Understanding this connection helps investors see the complete financial picture of a company. To conclude, the statement of changes in equity is a very important financial statement. It explains how the company's equity changes due to profit or loss, dividends, share capital transactions, and other comprehensive income. For investors, this statement shows how the company creates value for shareholders. For accountant, it ensures transparency and proper reporting of equity changes. Understanding this statement helps us better analyze a company's financial performance and financial stability. Thank you everyone for watching this presentation on statement of changes in equity. I hope this video helped you understand how equity changes during an accounting period and how accountants report those changes in financial statements. Understanding this statement is very useful because it helps us see how profits, dividends, and shareholder investments affect the ownership value of a company. If you found this video helpful, feel free to like, share, and subscribe for more videos related to financial accounting and finance concepts. Thank you.